Here's to Main Street, not Wall Street. Here's to being invested in each other. Here's to a return to what matters. Elevations Credit Union. It matters where you bank. Visit us online to see why.
Well, thanks for coming. My name's Ryan Sahd, and this is Clay Malcolm. I'm with FirstBank. My office is up north in Fort Collins, but I've been with the company for just about 10 years now, and I've been in retail banking for about 15. Clay has been with New Direction for about 3 years. I'll let him kind of tell you his story, but we're excited to do this class. We think that it's an interesting niche in the world of real estate investing, one that for as long as we've been offering the product from a financing standpoint, I just can't believe that it's not utilized more than it is. And you know, I've seen a handful of agents over the years that have really kind of exploited it, and I think that they've done very well, being able to learn the product and offer it as a niche to various investors, especially investors who have disposable IRA funds or retirement funds and want to be able to kind of diversify where they're investing those. So I hope you guys get something out of it, and I hope that more than anything it helps you to offer a new line of opportunities to your investors and the clients that you work with, and ultimately help you do more business. So I'll let Clay tell you a little bit about himself, and then we'll kind of jump into the formalities of setting up the IRAs and getting them to the IRA funds to the point where you can invest them, and then I'll kind of take over and let you know how they can use leverage in order to kind of grow that investment.
Thanks, Ryan. Good morning, everybody. How are y'all today? Good. My name is Clay Malcolm. I'm the Director of Business Development at New Direction IRA. We're a self-directed IRA provider. We're a national company, but we're headquartered up in Louisville, and where we will always be, I'm sure. We all love it there. And so today my part of the presentation is to talk about the IRA itself and give you a sense of how that would work, so that and it has the knowledge base has a couple of benefits for real estate professionals, and we'll talk about that. And then along with the tax advantages and the concepts that I'm going to be sharing about investing in real estate, we're going to focus then on leveraged real estate within the IRA, which is a really unusual opportunity. It's one of the only ways that the IRS will let you make money in your IRA on money that you didn't have to contribute, that you didn't have to follow the annual contribution rules. And that's the part that Ryan's going to really delve into. I want to thank Ryan for having me on the presentation today. It's always nice for me to be able to present with other experts. We, as self-directed IRA providers, don't give any tax, legal, or investment advice. I'm going to tell you all about how the IRS views the account and its mechanics and things like that, but a lot of the rest of the process that the account holder goes through, choosing investments and choosing their strategy, is something that we don't really weigh in on. We're a service for the account holder. We don't sell any assets or advise them on that kind of thing. And so one of the things that's nice about being anywhere where there's a room full of experts is that people can start to put the equation together. So I'm really excited to be here. And you know, one of the cool things about my job is that it's one of the jobs where everybody can win on when the setup is right. So somebody has an IRA, they have an expert real estate professional that they trust. You guys find a property that's going to produce some money or some returns for their IRA. And if they don't have the full purchase price, they can use the leverage. And everybody does a little business, and the IRA holder hopefully makes lots of money for their retirement. So it's one of those cool setups where everybody gets to win. And that's not in every deal. Okay, let's go ahead and get started. So the two general benefits that I think that this knowledge base has for real estate professionals are these. First, for your own retirement. If you have a SEP or an individual 401k or a traditional or a Roth, the expertise that you have in real estate can be exercised within that account, keeping the tax benefits, to produce returns for your own retirement. So most retirement accounts are mobile, meaning that they can be moved into position to buy these types of assets, alternative assets they're usually called. But a lot of people don't know that. And certainly if you have an IRA at Schwab or Fidelity, and you ask them, hey, can I do real estate? Well, they're going to say no because they don't handle real estate. We'll talk about a little bit how the IRS views that and why they would say that. But you need to be with a provider that would handle the real estate part so that your account still gets the tax benefits but can have hard assets. So knowing about self-directed IRAs could benefit your own retirement strategy. And secondly, and as important, if not more important, is it could benefit your business, right? So when an IRA, which is its own legal entity, goes out and buys a property, let's say a rental, a condo, it's going to pay for professional services just like any other buyer, meaning a commission to the real estate professional, title companies, everybody's involved with a regular transaction is going to have the same, it's basically the same transaction. The paper trail is a little bit different because all the paperwork comes through the IRA provider, but generally speaking, the setup is exactly the same. And one of the reasons why it's a powerful business tool at this point in particular is because there are so many IRA funds, people who have their IRA funds on the sidelines. Since the stock market has had some volatility and a couple of major dips in the last 12, 13 years, a lot of people have their old 401ks or IRAs on the sidelines. They're just in cash. And they don't even know that they can invest in alternative assets or hard assets. They think that they either have to be in the stock market or out. And so as a real estate professional, as a trusted part of these folks' financial world, if you just introduce the concept of, hey, did you know an IRA can buy real estate? That may be the first time they've ever heard of it. As an employee of New Direction IRA, I've said that at many an outing just casually, and people look at me like I'm from outer space, or that's illegal, or that's some kind of a scam, or things like that. None of those things are true. So it is a novel concept, and in a lot of cases, you're the right person to introduce them to that concept. Now, it's not for everybody. Not everybody's going to want to do it, but certainly if you do some sphere marketing and you are, keeping in contact with your contacts and your existing clients, that just introducing this concept may also yield a further business relationship with you and that person. And you've already invested in the relationship. So it's not like you have to do a whole lot of additional marketing or outreach. So that's the second way that this knowledge base, I think, is very beneficial for a real estate professional. And, some people will say, well, what does that sound like? Whoop, too fast. What does that sound like to introduce the concept? And I think it's as easy as, did you know that this is possible? But also it could be, are you interested in investment real estate? A lot of people come to us because they're interested in a particular asset, and they have some expertise in it, or they have some interest in it, and so then they'll decide, oh, well, I can also invest in that asset with my IRA. So the conversations are a relatively easy one to open up, and again, some people won't care, some people won't be interested, but some will. And like I said before, it's a team effort. Everybody, the IRA provider works with the real estate professional, title company, the investor, and hopefully, if the person is really comfortable with leveraging that money, hopefully the lender as well. And again, this is one of those equations where everybody can kind of come together and make a big win. All right, so self-directed IRAs, sometimes the terminology gets a little bit misunderstood. All that really means is that the account holder is going to have a choice of the assets that they have in the account. So that choice could be between two mutual funds, if you're with Fidelity or Schwab or whatever. But if you're with a provider that handles alternative assets, it could also be a choice between real estate, precious metals, private equity, lending, all kinds of stuff. So an IRA can do all kinds of asset acquisition. And so sometimes people think that a self-directed IRA is actually a different type of account, some designation from the IRS, and that's not the case. The account type is still the ones that, is that me banging?
Hey, just real quick, if you want copies of the slides, just get me your email address at the end and we can email it to you.
Yeah. So, thank you. So the account types are the ones that you're used to already. So traditional Roth, SEP, simple, individual 401k, or even a larger 401k plan in some circumstances, and HSAs. So HSAs is one of the ones that's really climbing fast. They've only been around for 10 years, but their tax benefits are incredible. Pre-tax money in and no tax on the way out for qualified medical expenses. And it can be invested just like an IRA for long term. So you can literally be investing for your life's medical expenses by having an HSA and investing it. So the account types all carry the same contribution limits and the same distribution rules and the same tax benefits as you're used to. So Roth is post-tax money in, hopefully tax-free on the way out. Traditional is pre-tax money on the way in, taxed on the way out. So those things don't change. The thing that changes really is what that money buys once it's in the account, and that's what we'll be talking about. The IRS, for all of its reputation, really doesn't endorse or approve any investments, nor does the IRA provider. The IRS gives us a couple of broad categories that you can't invest in, and I'll mention those just in the next slide. But other than that, really, if you're following the disqualified person rules and some other mechanisms, you can invest in almost anything. In fact, almost anything that you know how to make money at outside of your IRA, you can make money at inside of your IRA. So here's the two broad prohibitions that the IRS sets forth. So these accounts can't buy life insurance and they can't buy collectibles. Life insurance is pretty self-explanatory. Collectibles really is pretty easy as well. Artwork, rare rug. I often get the car one. So somebody will call me and they say, oh man, I saw a 65 Mustang on the side of the road. It doesn't look too good, but I can do the restoration. I'm going to have my IRA buy it. I'm going to fix it up and make a ton of money for my retirement, which is a great strategy. But unfortunately, that would be considered a collectible. So that would be prohibited. Every once in a while, there's some discussion about coins for precious metals and things like that. And if you ever have any questions about this stuff, just give us a call. We're happy to answer. So with those two broad prohibitions, that leaves a pretty wide swath of things that you could possibly invest in. So precious metals, that's gold, silver, platinum, and palladium that are allowed. Bullion products. Any company, public or private, you're probably used to GM, but if you have a cousin who has a widget factory and the widget factory is recapitalizing to launch widget 2.0 and they're going to let you buy some private stock, your IRA could be that investor. And all of the returns would go right back into the IRA and stay in that tax umbrella. Lending, an IRA could be a lender. It can be secured by collateral or not. That's really up to the IRA holder. The IRS really just wants it to be a real economic transaction. I put the industry one up there just to kind of show that, you know, commodities and industry, all those kinds of businesses are possible investments as well. So the company that builds the rig, the trucks that move the crude, the refineries, all those kinds of things would be possible investments as well. And then I started with a couple pieces of real estate. We're going to go into that in a little more detail, so I'll go through that. But one of the things I think that some people also think is it has to be residential rental real estate has to be the investment, and that's actually not the case either. Agricultural land is fine, land speculation, all kinds of, almost any instrument in the real estate world is a possibility. Okay. So let's hone in on real estate. See how I'm doing on time? Pretty good. And we'll start talking about some of the rules so that you get a sense of what the possibilities are and also what, you know, some of the limitations are. So it could be single family or multi-unit, apartments, condos, commercial, improved or unimproved land, mortgages, leases, options. The property doesn't necessarily need to be in the United States. We had a little run on Belize, I think a year and a half ago for one reason or another. Trust deeds, and then the star of the show today, leveraged properties, or you can do it unleveraged. And we'll talk about that as we move forward. Fix and hold, fix and flip. It doesn't have to be an income-producing property necessarily. Any of the other tools that you use to acquire properties like short sales or foreclosures are possible, as well as auctions. There are some logistical things with those mechanisms, so you'd want to call the provider ahead of time because the mechanics of that can be a little bit more difficult. All right. So going back to this broad concept of somebody will call the office and they'll say, hey, I want my IRA to be invested in real estate. And I say, great. So what is it that you're thinking? They're like, real estate. And as you guys know, it's such a broad world, right? There's all kinds of things to get into, as well as structures. So this slide is meant to give you a sense of the structures that the investment takes when they get in. So an IRA, again, its own legal and financial entity, separate from the person who owns it, can be the title holder on a piece of real estate. So it can literally go out and buy a property and receive all the rental returns if that's what they're doing, or if they sell that property, all the proceeds go back into the IRA. So they can, an IRA can own the property 100%. If the account does not have the full purchase price, or if the account holder also wants to share some of the returns either with themselves or with somebody else personally, they can be tenants in common on the title. So an IRA can partner with another person, can partner with another IRA, could partner with a company, can be multiple partners. All of these tenant in common arrangements are side-by-side, undivided percentage ownership in a property. And that's going to become important when we start talking about disqualified persons. Because you can't do a lot of transactions between yourself and your IRA. Those are prohibited because you're a disqualified person, and again, I'll talk about that in a second. But you could be a side-by-side owner with your IRA. So it's very common for somebody to say to me, hey, I want to make some money from my IRA, but I also need a little cash income for myself. And so the person, Clay, I'd say I'm going to put in 40%. And then over here, Clay's IRA is going to put in 60%. So that's totally fine. We would be tenants in common. The percentages would be on the title work. And every expenditure for purchase and maintenance would be split 60-40, and all the returns would be split 60-40. And you can really think about it in terms of two financial worlds. There's the 40% over here for the person, and the 60% for the IRA, and each of those follows their own rules. So that is a possibility. And it can be a little tricky. So again, this class is a relatively short one, so if you have further questions or I hit on something that starts your imagination churning, please feel free to give me a call. I'll have some cards up here at the end and I'll have my extension on them, or you can visit our booth at the Expo Center down there. An IRA can be a lender. We talked about that before, so sometimes that means that the IRA is going to be a real estate lender and invest in an entity that's investing in real estate. So all that really means is that if you want to collect the money into an LLC or an LP or some other entity like that first, you can do that as well. And really that's a private equity investment for the IRA. So it's going to buy X percent of the entity, or it's going to get X shares of private stock in that entity. Right? So, and a lot of times people are doing that to either spread their risk out, so they're in a real estate fund, a private one, or they're just collecting money to buy a much bigger asset. So any of those possibilities are available. Okay, IRS rule time. Try to get through this with a minimum of pain. The IRS is going to trade you some tax benefits in exchange for following the rules, so to speak. And part of what they're doing is just tracking that money. They want to make sure that you don't violate the amount of annual contributions that you're supposed to put in, and they want to make sure that they get the tax that they're due on the way out. In a Roth, that's none, hopefully, but they're just tracking that money. And one of the things that they put in place to help them track that money is this no self-dealing concept. And basically what that means is that the IRA has some restrictions about who it can have transactions with, and the IRA holder themselves is not really supposed to take personal benefit from the assets that the IRA owns while they're in the IRA. The IRS has this fantasy, well, it's not really fantasy, I guess, but this desire to have my IRA make third-party kind of arm's length investments to make money for my retirement before I actually get any benefit from it. Right? And again, that's part of because they're tracking the money. So this self-dealing idea we're going to talk about over the next couple of slides, but basically it means that some transactions cannot occur between disqualified persons and the account. And I'm going to take the two words one at a time, self and dealing, and hopefully that will help clear it up a little bit. Every IRA has a set of persons who are disqualified to it, and that starts with the IRA holder and their spouse, ascendants and descendants, and the descendant spouses. So all of these people are considered to be disqualified persons. And that's their personal finances as well as any entity that they own or control. So lots of times people will say, well, gosh, I want to do a transaction with my son or daughter. I know I can't because they're disqualified, but they own an LLC. Is that okay? Unfortunately not. One of the common misconceptions, though, is that means all family members are disqualified, and that's actually not the case. The sides of the family tree are not disqualified. So, anybody else kind of flabbergasted by the arbitrariness of that? Whatever shenanigans were going to happen with your parents or your kids, they won't happen with your siblings. Never happen. So, don't understand why this is. Doesn't really matter to a certain extent at this point. It's just the way it is, and it is kind of arbitrary. So, if you hear somebody say all family members are disqualified, that's actually not the case. And I just mentioned this before, so it's not only their personal finances, but also any entity that they own or control. And so what are the things that those disqualified persons can't do? So that was the self and self-dealing, so to speak. And so what is the dealing part? Well, those people can't sell something they already own to the IRA, nor can they buy from the IRA. They can't get into any credit arrangements like lending or extending credit. They can't provide services, which extends to sweat equity, which for a lot of real estate investors is a bit of a problem, or at least something to think about in terms of their calculation. So the IRA holder is the decision maker for the account. They're going to decide what happens on the property, but they can't actually go over there and install a new fridge or build an addition or any of that kind of stuff. So you have to be a little bit careful about what services you provide. And for real estate professionals, that sometimes comes into play on this one on the lower right, which is getting paid by your IRA. So let's say that you have a SEP IRA and you want to invest in some real estate. So that, normally if you participate in that transaction, you might derive a commission. So you can still be in the transaction and in the negotiating stage. In fact, you have to be, because the IRA holder is really the only one who can do that. But you would not be able to derive a commission. So mostly what I see in that particular case is the real estate person will talk to the seller and they will negotiate a price difference that, lo and behold, is very similar to what the commission would be. So you just want to make sure that there's no paperwork involved in the transaction that shows that there's a line of funds that are associated with the IRA purchase that comes back to you because you're a disqualified person. And again, I know I'm running through these concepts relatively quickly, so please feel free to ask us at the office or at the, yeah. Yeah. Correct, both. So he's asking, is it about compensation or is it about the work? Both are prohibited. So the compensation part is part of this getting paid one. The work part is really, if you think about it from an IRS perspective, which I know will hurt everybody's brain, they think that, oh, well, you contributed to the IRA, but we don't know how to track it. We don't know how to tax it. We don't know that you're evaluating it properly, all that kind of stuff. So it freaks them out. So you can't do it. If your tenants in common, you're aced out, right? So even if your IRA owns 1% of a property, you're out of the equation. I mean, the question I get asked all the time is, if I'm 50% owner and my IRA is 50% owner, why can't I live in it 50% of the time? Well, and the logic is sterling. I mean, I think, well, gosh, that really should be, but that's just not the way it works. Correct. Or rent a rental property. You're really not supposed to take any, those disqualified persons are not supposed to take any use of it. We had a guy who, with his IRA, he bought hunting property in Texas, deer hunting. And so the hunters rent it, and his IRA gets all that money, and he's like, well, why can't I go down there for 2 weeks and do some hunting? Well, I think you should be able to too, but the IRS doesn't allow it. So.
Can you manage it and collect the rents? You have to have a private management company do it.
That's a good question. So he's asking about property management. Again, it's a little bit of a arbitrary line. So you can do the brain power, but you can't be the property manager on record. You couldn't receive any compensation for it. So for instance, we see people who will actually receive the rent check. The check is made out to the IRA, but they'll receive it in the mail. They'll take it out of the envelope. They will not cash it because it's not supposed to really be in their hands. They'll put it in another envelope and send it to us to put in the IRA. Right? So they know that it got paid on time. They know that it's the correct amount, all that kind of stuff. But technically speaking, as a property manager, it would have to be a non-disqualified person. And technology is really changing a lot too. So we actually, and not all IRA providers do, but you might find some, but we do electronic rent receival for the IRA. So your tenants can pay by e-check if you want to, and it shows up on your online client portal right away. You can also do online bill pay for free. So if you have to pay somebody to paint the house, you just go on your portal, type it in, pay, Ed's painting $2,000 or whatever it is. We pay the check for free and off you go. So the technology is changing a lot in terms of making it easy because the property management part has been clunky. I'll totally own that.
So I get the restrictions, and this is a bit facetious, but can you drive by your asset? Can you advertise it? Can you show it? Can you secure the renters to occupy it?
It's a good question. So he's talking about the level of participation in some of the management things. So advertising, typically, I see that a lot. So I think that there's a good track record for that. So none of this stuff is written down by the IRS, by the way. The thing that you're trying to portray to the IRS is that you are doing the things that you need to do as a decision maker for your account, but you are not straying beyond that to provide professional services or in some way enhance the account. So it's very common for me to see an IRA holder have us send money to someplace to place an ad, to look through the applications, to make a choice, all that kind of stuff. It's very common, and to drive by and see what's going on. So, the thing that we always say sometimes just to get people in the ballpark is you can go and look at the wall, decide it needs to be painted, decide the color, decide the type of paint, but you couldn't put the brush in the can to actually do it yourself.
Sorry to interrupt again. I understand everyone has a lot of questions regarding this. This is a kind of a unique sort of situation. For the sake of trying to get through all of our material and being respectful of your time, let us try to pound through this, save your questions. We'll try to carve out some time at the end, and anything that we don't cover, you can talk to us afterwards and email us, and we'll get you taken care of.
Good. Okay. Thank you, Ryan. Okay, so I mentioned that the IRA is a legal entity of its own, so it has its own titling. You'll probably recognize this naming convention from any IRA that you've ever seen. It's the company's name, FBO is for benefit of, the account holder's name, and then the type of account. Because there's some public record involved, if you want to use your account number and not have your name on there, we allow that as well. Or you can do both for added specificity. But very important that every piece of paper that's associated with the acquisition has this titling and not your personal name, or not the IRA holder's personal name. So everything from the offer to the closing docs to insurance, taxes, all that stuff is in the name of the IRA, not the person, because the person is disqualified. And this is kind of my don't step in a mud puddle slide. So these are the two things where people get in a jam right out of the gate. So you got to make sure that the offer is in the name of the IRA, and then you also don't want the earnest money coming from any disqualified person. So it needs to come either from a non-disqualified person who can be reimbursed by the IRA later, or if the IRA is already set up and funded, then the IRA can just pay the earnest money straight away. Right? So again, all of the money comes from the IRA, all the receipts come back. It's a little bit of a closed financial system. Now we get to the really cool part. So we talked about all those other ways that stuff can get into the IRA, and all of it's true, and it's really up to the account holder. But as I mentioned at the beginning of the presentation, it's really unusual for the IRS to allow an IRA to make money on some money that it didn't have to contribute. That's usually the limiting factor. And it's one of the reasons why I mentioned SEPs and individual 401ks to folks who are typically self-employed, is because the annual contribution limits are so much higher, right? So, and again, this depends on everybody's strategy, individual strategy, but there are some advantages to certain characteristics of things. And this idea that you would not have to actually make contributions to make money, I mean, or increase your IRA's buying power without having to contribute it, it's really a powerful one. Not all lenders will do it. So we happen to be so lucky in this marketplace that FirstBank is here to talk to us about how it works and, gosh, handle all that stuff. It has to be non-recourse, and Ryan will talk a little bit about that. No personal guarantees, of course. And then my last kind of factoid thing is there may be something called unrelated business income tax that's associated with the percentage of ownership attributed to the debt leverage. It's not a penalty. It's just a cost of doing business. It's part of the way that the IRS will allow you to make money on this loan. It means that your IRA may need to file a 990T. That's not a gratuitous thing. We have a sister company that does them. And the IRA pays that tax. UBIT is unrelated business income tax. And the IRA pays it, so it doesn't affect your personal taxes. It's all a machination of the account itself. And if you have more questions, that really is kind of a deep subject at some point. So, but I'm happy to answer any level of detail you want. So here's my spinning graphic slide. So if you have $150,000 that you've contributed to your IRA and you buy some stocks, good for you. That's awesome. Seriously. So you have $150,000 worth of stocks. If you contributed $150,000 and you put it in your IRA and it bought a piece of real estate, then you have $150,000 worth of real estate. Again, tremendous. But if you're comfortable, or whoever is comfortable with the debt leverage strategy, you're $150,000 and making it 300 may be a little might be a little bit of an exaggeration, but the idea is you can increase your buying power enormously, right? And all of the proceeds, notwithstanding if you have to pay some UBIT, go right back into the IRA. So you just bought a much bigger, hopefully, property with much bigger cash flow that comes back. So anyway, that's the cool part of it, I think. And with that, I think I'm going to turn it over to Ryan. Pretty close.
Well, thanks. Yeah, that's good. It's always nice to hear New Direction give the logistics of the IRA piece. It's always a nice reminder. So from our standpoint, we're mainly coming in once the IRA funds are in a position where they can invest into real estate, right? So a lot of times, again, we'll have knowledgeable agents that are talking to their buyers about it. Maybe they're helping them out with buying their primary residence or in a piece of investment property, and they say, hey, do you have other funds that are available to invest? Well, no, but I'd love to get some more real estate. Well, what does your retirement look like? Did you know that you can retire, that you can use some of those funds to purchase real estate? And oftentimes they do, but I mean, I don't have $500,000 of retirement funds that I could purchase real estate and own it outright with my retirement fund. So oftentimes that's where the leverage piece comes in. Maybe they'll have $50, $60, $70, $100,000 that they're willing to carve out for investing into real estate. But the piece of real estate that they'd like to purchase, I mean, is going to be upwards north of $200,000. So the real estate piece of it, I think that a lot of people respond well to just having an asset that they can drive by, that they can see, you guys understand the market. I mean, I know that, with real estate, it's an asset that I understand, and I know, I have a better idea of just what's going to happen more likely with the appreciation of the asset over time. So I think that there's a lot of value to that. Let's see. So a couple of things to touch on, I guess, really quickly from the bank standpoint compared to New Direction. We are pretty sensitive about the self-dealing, right? We really do want that arm's length to be there. That's important to us. So the tenants in common example, if you have enough cash in your IRA to be able to purchase it outright and not need leverage, and you want to be tenants in common with yourself personally, then great, that's fine. But if we're doing a loan scenario, then we probably wouldn't allow that. We do want to make sure that there's sufficient arm's length so that there's no potential self-dealing there. Let's see. What type of assets that you can purchase and use leverage, for us, the biggest thing is it needs to be income producing. Because it's a non-recourse loan, so we're putting a high degree of importance on the asset itself. It's non-recourse to the IRA beneficiary, so that's important to remember that our borrower is the IRA. You, as the beneficiary, are simply directing those IRA funds. So it's non-recourse to you, it's recourse to the IRA account. But as a result, it's important to us that that asset is producing income. So if you're purchasing, land or hunting land that produces nominal income, we're not going to allow that from a loan perspective, because we want to be able to show that the asset itself can service the payments on the loan. Does that make sense? And then, with the UBIT, more often than not, at least from our what we've seen, UBIT a lot of times gets taken care of for buy and hold scenarios. The unrelated business income tax a lot of times won't be as big of a factor if you're buying and holding it, because you're able to depreciate the property. But if you in a more rare scenario where someone is flipping properties or getting more short-term gains on that real estate, then that's more often than not where the UBIT comes into play. So we've talked about plan qualifications, property qualifications, underlying participant qualifications is what we'll kind of look at now. Plan qualifications. So again, the funds need to be in a position where they're able to be invested. So oftentimes people will come to us or they'll come to you and you say, okay, get your funds rolled over with a custodian that allows you to invest it. That's no different than rolling over funds from Fidelity to Schwab. You just do a simple rollover request. They get deposited with a qualified custodian, in this case, New Direction. New Direction then is our applicant, right? So I mean, they're the entity that's going to be going under contract. They're the entity that's going to be borrowing on the loan. We only allow single member plans, no multiple employee plans. Oftentimes some plans can come together to purchase a property. I'll talk a little bit in a second about how some people are even using limited liability corporations to be able to pair together retirement funds to purchase investment property and some commercial property. But the biggest thing with us is that we want to make sure that the plan itself, the two main things, that the plan itself has the capacity to borrow and has sufficient liquidity after the purchase takes place to solve problems. Because remember, if you use up every bit of retirement funds that you have to purchase the real estate, and then you do need a new water heater, or you do need to get the siding redone, or some sort of capital improvements to the property, you as the IRA beneficiary can't cut a check for it, right? So it's important to us that after the transaction takes place, that the IRA has sufficient funds in there where the IRA can cut a check to fix up the property if need be, and also cover any vacancies. So I mean, if there are any vacancies with the property, any sort of normal capital expenditures that you would normally expect to see when owning real estate, investment real estate, the IRA has to cover all of those expenses. So that's important to remember. Property qualifications. So more often than not, we see 1 to 4 family residential properties. So I'll go through an example in a second, but the typical transaction is going to be in the $150 to $250 purchase, where the IRA is contributing 35% of the purchase price, and then they're using leverage for the rest of it, so a 65% purchase. So more often than not, your average individual doesn't have enough retirement funds to be able to do larger purchases than that. Sometimes we do see individuals that do have larger amounts in retirement that they want to invest, and they're able to go into a larger scope property, actually get outside of the 1 to 4 family realm and purchase a apartment complex. That's completely fine, but it's just not as typical. For us as a lender, we're putting a lot of priority on the assets, so we want to be able to understand the property. We want to be able to drive by it. That's important to us that we see that our collateral is there. So we are limiting all of our collateral mainly to the Front Range, as well as some select mountain communities. We have, knock on wood, not taken many losses on these loans. More often, and again, it's because we understand the asset. The most recent one that we did take a loss on was up in a mountain community where we weren't familiar with it. We didn't look at it. We couldn't see it. It was more, rents on the Front Range, you guys would agree, are a little bit more stable. In mountain communities, it's more dependent on the economy. So when the economy went down, the rents on the property dried up. It's non-recourse to the individual. The individual walked away from it, turned it over to the bank, and we ended up having to reclaim it and take a loss on it. So that's why now, if we can't see it and if we can't analyze the local, regional economy for it, then we're just not going to allow it as collateral. And then the cash flow, we'll get into this in a little bit more specific, but we want the cash flow of the property net, so the net cash flow after expenses and projected vacancy to be able to cover the payments on the loan. So that's the most important thing to us. No lease is required at closing, but we would require a rent schedule on the appraisal to kind of give us an idea of what the rents would go for, so that we can kind of do our projected cash flow on the property and make sure that our loan is going to be covered. Amount of leverage, I kind of touched on this, but we'll go up to a maximum of 65% of the purchase price or appraised value, whichever's less. And generally, that's we generally don't do less than that. Most often, people want to get as much leverage on these as they can. And at 65%, it does cash flow pretty well. So here's just I tried to put together an example of kind of what our most typical transaction looks like and how that is going to produce return back to the IRA for the IRA beneficiary in a couple different ways. So it's going to be, your IRA is going to be growing by way of appreciation of the asset, which is typical, and then also cash flow that the asset produces, net cash flow. So in this case, monthly rents, this is for a purchase, $200,000 purchase, 3-bed, 2-bath. Maybe 200 right now is a little bit optimistic with how prices have been increasing, but 65% mortgage, so 130. The IRA contribution is 70,000. Again, the rollover or the amount that the beneficiary has on deposit has to be a little bit more than that to cover the closing costs, and then also so that we can have some liquidity left over in the plan post-close. So monthly rents, $1,400. We're going to deduct off kind of our estimate for expenses and vacancies of 25%. So the discounted rents of $1,050 is what we're going to use for our example. The projected PITI payment of $924. So in this case, it has a coverage ratio of about 1.13. And on all of our loans, when we do that math in order to qualify the asset, we want it to at least hit a 1.0 or higher. If it doesn't, then we wouldn't allow it. And more often than not, if a property under these calculations can't hit a 1.0 at 65% leverage, then it's probably not a good investment anyway. So net cash flow, 126, annual cash per month, annual cash flow of 1512, and that's the amount that goes back into the IRA. So the IRA is growing, the liquid balance in the IRA is growing a little bit as those rent checks continue to come in. So 7-year growth example, $200,000 asset value initially, initial leverage of 130, initial IRA investment of 70. After 7 years, the loan balance would be about 115,000. 7-year cash flow earnings, so again on that annual, just the net income from the property grows to about 10,000 in 7 years. Asset appreciation conservatively at 5% per year of 70,000. So at the end of the 7 years, the property might be able to net of sales cost liquidate for about 253. So the effective IRA balance after 7 years is 149. So that's pretty good growth in 7 years. I mean, I haven't been able to accomplish that in my non-real estate retirement funds, and I think that most of you would agree with that. So that's the main reason. When we start showing people these numbers, that's the main thing that gets their eye is it's an asset that I understand. I can drive by it. I'm familiar with the local economy. I know that it's going to be a little bit more stable over the years, and it's going to be growing in terms of just an average growth rate. It's generally going to be growing quite a bit better than you would in non-real estate assets. So step-by-step instruction on kind of just how the process works logistically. Even though it's non-recourse to the IRA beneficiary, we still want to know who we're working with, right? Because they're the ones directing the retirement funds. So we want to make sure that this person's at least a credit-worthy, competent individual who's going to be able to adequately direct New Direction to use those funds correctly. So we're still going to get a financial statement on the borrower. We're still going to pull credit, or not on the borrower, on the beneficiary. We're still going to pull credit on them, make sure that they're a credit-worthy individual. Once we get through that step, then they're going to roll over those funds to New Direction or to a qualified custodian. And then we'll get a statement from that custodian that tells us how much they have on deposit. And that's all we need for pre-qualification, is that statement. Because whatever amount is shown on that statement, we're just going to back into how much they could buy based on that 65% leverage. So if they give us a statement of 100,000, then we'll take probably 10% of that and say we want that to be carved out for liquid reserves in the account, and then we would just divide the 90,000 by 0.35, and that gives us the amount that they're able to get pre-qualified for. Once the pre-qualification letter is done, we can give that to you as the real estate agent, and you're able to use that to help them purchase the property. As they go under contract, it's important to remember that the buyer, so the contract has to be written up with the buyer as the IRA. In this case, New Direction IRA for the benefit of John Smith IRA. So that's typically how the buyer is listed on the contract. These take generally another about 3 days to a week longer to close because there's a little bit more due diligence on our end prior to closing. And then as all the IRA beneficiary does, again, they're not borrowing, but they do have to approve all of the loan documents. So they'll go through all of the loan documents and they'll initial off on it as read and approved. And that's their way of telling the qualified custodian that, hey, I'm okay with the loan. I approve you guys to take out this loan, to borrow. And then all documents loan documents are sent over to the custodian for signing. They're the ones that actually executed on it because they're the borrower. Let's see. Yeah, we've covered most of this. So for the sake of time, some other things that we're seeing, and I kind of touched on this, is some borrowers are actually directing their IRA funds into an LLC, which is perfectly fine. So we've had some, let's say you have a property that's just a larger scope that someone can't invest into on their own. They don't have enough funds to invest into it on their own. We've had some scenarios, and it's getting actually more common, where you have multiple people that might roll over their retirement funds into a qualified custodian and then direct the custodian to invest into an LLC as a member. So in a single member scenario, I take my funds, roll it over to a qualified custodian, and then say, okay, I'm forming an LLC to purchase the real estate. Qualified custodian, I'm directing you to be the member, 100% member into the LLC. I'm going to be the manager of the LLC, so I don't own it, but it gives me a little bit more control over what assets that LLC purchases. Does that make sense? So then you turn around and the LLC is able to purchase real estate, but then I, as the member, as the manager, have a little bit more control over the funds in that account. So we're seeing that more often. Again, it's important to talk to a CPA about that. Make sure that you have a CPA that understands business, understands self-directed IRA, ideally, and just do everything you can to just maintain that arm's length. The self-dealing is really the most important thing to avoid, but I think that is an interesting way that we're seeing more people direct their retirement funds, but also have a little bit more ability to be able to act with those funds as the manager of that LLC. So I hope that makes sense, and I think that for the sake of time, I'd like to go ahead and just see if anyone has any questions that we can address. And it looks like we do. So I think you had your hand up first. we kind of limit it to anywhere where we have a branch close by. So anywhere where one of our officers can go in and actually drive by the property, look at it, and give us some sort of regional economic forecast. I'd say if they can't drive there in under an hour, then we're probably not going to lend there. Does that make sense? Yep. Oh, yeah, good question. So it's generally going to be about just under 100 basis points over our normal owner-occupied rate in most scenarios. So I mean, you take our owner-occupied rate, and we're going to be probably about 7/8 above that. Another good thing to note is that it's only going to be loans that FirstBank offers on our portfolio, because obviously we can't sell this loan, so no 30-year fixed. It's going to be like a 5 or a 7-year ARM typically. Those are the most traditional products that these go into. Yep. 7/8 in rate, yep, and then there's a little bit of a cost premium as well on the origination fee. The origination fee generally is going to be about 1.5 points, and then your normal mortgage closing cost on top of that. Yep. Great.
If I understand it correctly, you have complete control over how much or how little you roll over, right? So 80%. Right. No. So with us, the cash position, and this is true for some of the custodians, it's FDIC insured, but it's not making anything. It's static. But you can keep it there until you've found a property and then move it just prior to closing.
So you can continue to make your contributions to your IRA here.
Sure.
So say you want to dump some more in here, can you just all of a sudden say I want to put money on roll over? Is there a charge for that? Or?
Yes, you can make, so you can have a couple of IRAs going. I overdid it a little bit, I have 5. So, but I can move money between them as often as I want via transfer. It's not instantaneous, it takes a couple weeks. Most providers will have some sort of exit fee if you're taking everything out or taking a substantial amount out. I know for us, we cap it at $250, so it would never be more than that. But every provider is different, so you'd have to find out about that. In terms of us receiving more money, either via contribution or transfer, we don't charge for that. And an account with us that has real estate in it can receive contributions just like any other IRA.
And we can do pre-qualifications based on an existing IRA too. I mean, if you're saying, hey, I don't want to roll this over because it's not going to be earning anything until in that time period from when I roll it over to a qualified custodian and right. when I start getting cash flow from the asset. So can you just qualify me based on what I have in my Schwab account? And then, but we would require that to be obviously rolled over and New Direction going under contract prior to loan approval.
We generally have it open the next business day. We quote 2 business days. The thing that takes a little bit of time is the rollover or transfer. Because we don't control it, it's coming from another custodian. I generally tell people to think about it in terms of 1 to 4 weeks. I had a particularly gnarly one. It took like 7 weeks.
Some custodians just aren't excited to let the money go. I don't know why.
Yeah.
Listen?
I think you answered it, but you're allowed to continue to contribute to it even when it's put in the qualified custodian.
Correct. You can continue to contribute as long as you're eligible to. So obviously Roth has some restrictions and things like that. But yes, if you qualify to contribute, make an annual contribution, you can continue that process. Even after you've bought real estate with it.
And then you could theoretically use that money to do improvements or go out and buy more real estate.
Exactly, yes. So she was mentioning that you could take those contributions to do improvements on the property or buy something new, combined with the cash returns of the first one. It's whatever your strategy is, but you're not limited just because you have hard assets in the account, yeah.
Yep.
great.
That's great. We've had some agents that we work with that, over the past couple of years, they've done probably 20 additional deals just because they understand this well and are able to guide their potential buyers through it. So.
And even after this 50 minutes or an hour with Ryan and I, you guys know more than 80% of the rest of the real estate professionals in the country.
It's just remembering to ask.
Seriously.
When you said that you guys don't have to have a lease on the property, so how do you calculate the projected rent for your
We'd generally get a rent schedule on the appraisal. So have the appraiser just look at comparable rents, yeah. We would like to have a lease ideally we'd like to have a lease in place prior to closing, but sometimes it's just not ideal, and that's okay. Yeah.
You have no restrictions on mountain properties, only if you're leveraging.
Right.
Correct. So if you choose a property that's outside of their lending area, then you probably have to find somebody
I'm
else.
not saying that we can't do mountain properties. I'm just saying that we're gonna look at it and make sure that it's close enough to one of our. We have branches all the way up. Yeah, we have. We're in Grand County now.
You are?
Aren't we?
You have a branch in Grant County? No.
Not Grand County. No, Grand Junction. There is a difference. Yeah, a little bit. All right, so Grand County, you might be out of luck. But it doesn't. We can do whatever we want if it makes sense. So we've had some folks still where they're good borrowers of ours, good customers of ours, and as a courtesy to them, they want to buy something in Steamboat, they want to buy something farther away, then that's okay.
I have a question, probably for both of you. If you are doing a deal with New Direction and it's going to be a nightly rental, can you manage it like through VRBO?
Well, from our perspective, and the IRS would be, you could contract that service. Your IRA could contract that service to.
VRBO is yourself, it's like your self-contract.
Right, but they're like the clearinghouse, right? They bring the person, right? So after that, after the person comes in, you would still have the same restrictions that we were kind of talking about over here. So you can be the decision maker, but so on a nightly one, that would be tough. And the way I usually describe this is, think about yourself sitting in a room with an auditor from the IRS, and he's saying, I think you contributed services. How many hours a week did you work for your IRA? And if you tell him, I don't know, 5, 10, 15, nobody knows what the number is, but you're trying to convince that person that all you did was make decisions for the account and that you weren't working for it. So, yeah.
If you're a 50-50 owner with your IRA personally, right, then could you do some work on the property yourself?
Unfortunately not.
And I have to tell you, right now I'm doing a deal with New Direction, and it's been fantastic. Because I didn't know what I was doing going into it, and it's actually my husband was my client. And they've just been so great at explaining everything. It's really been interesting.
I'm glad to hear that. Thank you.
What kind of restrictions do you see in investing the IRA real estate or do you see
Trends?
as far as is it growing? Is it
I think it's growing, but not as fast as I would have expected. Again, it just continues to kind of boggle my mind that more people aren't doing it, and I think it's just a knowledge issue amongst real estate agents and just letting people know that it's out there. The people that start doing it, I find, those are the ones that it really takes off. We'll get people that'll do one, and then they just kind of become obsessed with it and start really doing quite a bit.
Now, when you go to sell it, if you're a realtor, I'm assuming you're not allowed to list it on your behalf if you own it.
So the
You
question
can't.
is about listing if you're selling. Again, I would say if you can the further away you can keep it from your own personal services, the better off you are. There's no yes or no answer.
Even if you didn't take a commission.
Right. So there's the commission part, which is receiving money, but there's also this providing services part, and I think that's somewhere that particularly you guys would have to have more sensitivity to. So
it's a gray area. I mean, the self-dealing, I mean, I'm never going to get in trouble for self-dealing, I mean, as a lender, but we just try to help people stay away from it as much as possible, because the IRA holder is the one that could get in trouble if the IRS actually did come in. And this is, I mean, the IRS does pay attention to these. I mean, they do look at these pretty carefully. So, I mean, if they see any self-dealing, they're going to be on it. I don't know who's...
If you contribute using money from a Roth IRA that was taxed before it went in, once you go through that appreciation, say off your graphic you did, over 7 years, is that going to be taxed or capital gains associated with that, or does that stay under that umbrella of protected funds?
Yeah, the question is, if you have a Roth and it makes a good amount of money, is it still going to be distributed tax-free? The answer is yes. If you have leverage, again, the only thing that you might encounter is UBIT along the way, but from a distribution standpoint, yeah, you can make as much as you want.
I think that we're out of time. I appreciate you all coming, and if you have any other questions, please come up and let us know. And if you would like a copy of the slides, just get us your card and we'll email it to you. If you have any of the CE credit fill-outs, just bring them up here and we'll turn them in for you.
Thanks, everybody. Enjoy the day.